Welcome back to Professor FinTech, where we simplify complex accounting concepts for everyone. In today's video, we are diving into T accounting, also known as ledger accounts. We will cover everything from the basic concept, the ledger format, to the technique used to balance the ledger. Let's get started. Overview of T accounting. At the heart of accounting lies the ledger, which is where we record all financial transactions. In this video, we will focus on T accounting, a visual representation used to record transactions in ledger accounts. This technique helps track increases and decreases in different accounts. The reason it's called a T account is because it's shaped like the letter T. Debits go on the left side and the credits goes on the right side. Why use T accounting? Clear understanding of a transaction. T accounting provides a clear understanding of transactions that take place in business, allowing business to identify and correct errors in their financial records. Organization of a financial data. T accounting helps organize financial data in a logical and systematic manner, making it easier to understand and analyze financial information. Assistance with financial analysis. T accounting can help businesses with financial analysis by providing a clear picture of their financial performance, making it easier to identify areas for improvement. Benefits of T accounting. T accounting provides a clear and concise way to see accounts balances, debits and credits, and other important financial information, making it easier to understand and analyze financial transactions. In T accounting, every transaction must affect at least two accounts. For example, if a business buys inventory for cash, we increase the inventory account with a debit and decrease the cash account with credit. This ensures the books always remain balanced. T accounting or ledger format and structure. Now let's look at how a typical ledger is structured. Think of the ledger as the master record where every transaction is recorded, and the T account is just a simplified version used to visualize this word record. Each ledger account has account title. At the top you will see the name of the account like cash account, accounts receivable or revenue account. Debit side, this is the left side where you record increases for certain types of accounts like assets and expenses. Credit side, the right side where you record increases for liabilities, equity and revenue. T accounting is useful accounting method for small businesses as it is simple, easy to understand and provides clear records of financial transactions. Why prepare a ledger account or T accounts? But why do we even prepare a ledger accounts? Well, ledger accounts serve several key purposes. Track transactions. Every business needs a clear record of all financial transactions. Summarize financial data. The ledger shows the cumulative impact of transaction on each account. Prepare financial statements. Information from the ledger feeds directly into the financial statements like the income statements and balance sheet. Ensures accuracy. Ledger accounts helps ensure that debits and credits balance, which is critical for accurate financial reporting. Without the ledger, it would be impossible to create accurate financial reports or understand the financial health of a business. Basic structure of a T accounting or ledger. T-shaped diagrams. T account is based on T-shaped diagrams that represents accounts and their balances. The left side of the T represents debit entries while the right side represents the credit entry. T account. T accounts are used to record financial transaction in T account. They are an important tool for understanding the financial health of a business or organization. Debits and credits. Debits and credits are used to record financial transaction in T accounting. Debits increases the assets, decreases liabilities, while credits increases liabilities and decreases assets. The technique of recording transaction in the ledger or T account. Let's talk about the actual technique of recording transaction in the ledger. Each transaction follows the double entry accounting principle. This means for every debit, there is a corresponding credit. The total of all debit entries must always equal the total of all credits. To illustrate this, let's record a transaction together. Suppose you sell goods worth $5,000 on a credit. In this case, we would debit accounts receivable for $5,000 because the customer owes us money, increasing our asset. Credit sales revenue for $5,000, increasing our revenue. As you can see, debits go on the left and credits go on the right, ensuring that both sides balance. You can see this in the table. At left side, accounts receivable account and sales revenue account. These are the two ledger accounts are also called as a T account. In this entry, as we have shared, debit accounts receivable for $5,000. So debit accounts receivable $5,000 at a debit side with particular as a sales revenue. As we mentioned here, for every debit there is a corresponding entry of a credit. So this debit has a corresponding entry in the sales revenue account. So if you wanted to see this corresponding entry of this debit, where we will be able to see that in the sales revenue account. So let's go into the sales revenue account. In the sales revenue account, the same $5,000 as mentioned as a credit balance. So for this entry, where is the corresponding entry? It's in the accounts receivable account, and then so this way it works. Let's move on to the next, how to balance a ledger account or T account. Now let's look at how to balance a ledger account. Balancing the ledger ensures that all transactions have been accounted for correctly and the books are accurate. Here's how you do it. Sum the debits first, add up all the debits on the side of the account, sum the credits, then add up all the credits on the right of the account, find the difference. Subtract the smaller total from the larger one, the difference is your balance. Carry forward the balance. Finally, the balance is carried forward to the next period or used to close the account at the end of the accounting period. For example, if a cash account has a $10,000 in debit and $8,000 in a credit, the difference of a $2,000 would be the closing balance carried forward to the next period. So here is the example. You can see the table, cash account, debit, cash account, right? So debit has a $10,000 capital and credit has a furniture account $8,000. When the higher is the debit 10,000, so we will take $10,000. Here as well we will take $10,000 as a total, and the difference between $10,000 and $8,000 will be $2,000. This will be balance carried forward. So balance carried forward to the next year, next financial year, or it will be closing balance. Moving on to the practical examples, we will use a sample transaction to demonstrate how T accounting works. By creating T accounts, recording the transactions and calculating the final balances, we can solidify the concept we have covered so far. Let's deep dive with example. First, cash received as capital. So business receives $10,000 as a cash from owner as a capital. Capital received, so debit the cash account and credit the capital. We have created two T accounts. One is a cash account, which is assets, and capital account, which is equity. As we mentioned, debit the cash account. So debit the cash account 10,000 with particular as a capital account, because this debit $10,000 has a corresponding entry in the capital account. So when we go into the capital account, it has a credit $10,000, and this credits $10,000 corresponding entry is in the cash account, hence particular mention as a cash account. Let's check the second entry, purchase of a furniture. Bought furniture for $5,000 in cash. General entry will be debit the furniture account and credit the cash account. So T accounts are furniture account, which is assets. Cash account is also again asset. Then $5,000 as a debit, cash account, and particular we have mentioned as a cash account. Reason, the subsequent entry or corresponding entry of this debit is in the cash book. So in the cash book, it's a credit $5,000 mentioned in the particular as a furniture account, because for this credit $5,000 corresponding entry of a debit in the furniture account. So hope you are understanding this. So take example of a third, sales on credit to customer. Sold goods worth $8,000 to a customer on credit. So accounts receivable account $8,000 to sales revenue account $8,000. So we have a T accounts too. Accounts receivable, which is assets, and sales account, which is income account. Then accounts receivable account debit $8,000. So in the particular, what we mentioned sales account, because this debit's corresponding entry is in the sales revenue account. So here in the sales revenue account, we have mentioned the credit of $8,000, and this particular we have mentioned the accounts receivable because this customer owes us. We are supposed to receive this payment from the customer. Hence, corresponding entry of this credit 8,000 is in the accounts receivable. Moving to the next example, expense payment. Paid rent $2,500 by cash. Journal entry, rent expenses $2,500, credit cash $2,500. So T accounts, one is a rent expenses account and second is a cash account. So in the rent expenses debit, so $2,500 as a debit, and in a particular we have mentioned the cash account because corresponding entry of this debit is in the cash account. So in the cash account, it's a credit $2,500, and hence particular we have mentioned rent expenses account. So in a conclusion, T account is a tool used in double entry bookkeeping to track financial transactions. Each transaction affects at least two accounts with a debit on the left and the credit on the right. The ledger helps business track financial health and prepare accurate financial reports. Always make sure your accounts are balanced to ensure accuracy. By mastering T accounts and ledger accounting, you will have a solid foundation in bookkeeping bookkeeping and accounting. If this video helped you better understand T accounting, make sure to like, subscribe and hit the notification bell for more videos. And if you have any questions or need further clarification, drop them in the comments below. Thanks for watching and we will see you in the next video.